In this presentation, we will continue on with part 11 of our C Corporation Comprehensive Problem, this time taking a look at an M-1 related to the sale of equipment. We're going to have the sale of property, plant, and equipment, sale of a piece of equipment, which will have a difference, and M-1 related to the accumulated depreciation, which will have a different amount for the book and tax depreciation. Here we are on Form 1120. As always, it's a good idea to just make sure that we are in balance in the starting point so we have somewhere to fall back on if something goes wrong with this type of adjustment. So we are in balance here. Our book number is at the 14615. So if we go back over to our worksheet, we're at the 14615 and our tax number is at the 1407232. So there's the 1407232. We're going to be thinking about the sale of property, plants, and equipment. So if we go down to the depreciation schedules, let's start with the book depreciation schedule. We sold this piece of equipment. Now, we already recorded the sales item here, the date, but we only did so because we wanted to see what the depreciation would be for the partial year. We didn't look into the actual sales transaction at that point. In fact, we negated any kind of effect the sales transaction would have by adjusting the sales price so that it wouldn't have a gain or loss on the sale, so that we could focus on, at that point, just the depreciation component. Now we want to think about the actual sales component. So when we think about the sales component from a book standpoint, we have to consider the accounts that would be affected. The accounts that are going to be affected are going to be the depreciable assets, the equipment, the accumulated depreciation related to the piece of equipment that was sold. Notice we're not considering here the depreciation expense at this point, right? Because we're only considering the accumulated depreciation. We've already recorded the depreciation expense, and now we can focus in simply on the depreciation related to that piece of equipment that was sold. What we do have is the gain from the disposal of the equipment. So when we think about this type of transaction, we got to think, all right, did the bookkeeping department record this transaction, and did they record it correctly? So what we would want to do then is go back up top, and we would want to look at the depreciable assets, look at the general ledger for the depreciable assets, look at the activity for it. There shouldn't be a lot of it because there's going to be large purchases. Therefore, there's not going to be a whole lot of large purchases for depreciable assets. We could find out what those purchases are and get the detail related to the transactions involved within them. If we do that, then we can then consider whether or not the transaction has been recorded correctly and whether the accumulated depreciation and so on has been recorded correctly. Now, if we're working with them as a tax firm, and they're relying on the tax software, for example, they can ask us in the middle of the year, would you help us to calculate the depreciation, accumulated depreciation with relation to the sale? We could put that into our tax software and then give them the book accumulated depreciation. If that is indeed the case, they should record it properly into their system. If they're kind of relying on themselves and they don't have the depreciation schedules that would be in the tax return, then it might be the case we would have to make an adjustment for them. We here are going to say that the book depreciation looks like it's correct on a book basis, meaning if we were to look at our book basis, we'd say, okay, what would the sale look like? What would the gain or loss be? Well, we're going to say that we have the 50,000, and then we're going to say minus the 20,000 prior year depreciation minus the 2,976 would be 27,024 book value. And if we look at the transaction, we're going to say that it sold for, how much did it sell for? We're going to say, in our case, 29,524. We look that up in the transaction in the GL if it was in practice. Minus the 29,524. That gives us the 2,500 that we would expect here. So we've got the 2,500 gain. So therefore, it looks like it's been recorded correctly on a book basis. Now we have to consider the fact that it'll be different from a tax basis. So if I go to the tax basis up top, we're going to say, all right, here we had the same 50,000 minus the 30,000 prior year minus the 4,373. That's a 15,627. We're going to take that, and then the sales price. The sales price was this 29 minus the 2,9,524. There's the 13,897. for the taxes. So we need to record that difference. We're going to let the software help us to record it first, and then we'll try to think about it in terms of the Excel worksheet. So if I go back to our data, I'm going to go back up top and see what we have here. If we go to the, now you would think that there would be something like a gain or loss that would have happened here given the software, because if the software then would be recording this, we said that there was a sale, we should have a gain or loss recorded here, and it should record the M1 for us. However, we basically put in whatever number we needed not to have a gain or loss calculated so that we could focus in on just that one component. So what I'm going to do is go to that piece of asset that was sold again. I'm going to go to the detail. I'm going to go to the depreciation. Then we're going to go to the asset that was sold. Here's the piece that was sold. We're going to go down to the sales item, and we put in 15,627. Again, we just put that number in because we wanted it to calculate a zero gain or loss. In other words, if I remove this, and you might want to write it down before you remove it, but I'm just going to remove it and put -1, which means 0 for Lacert. So -1 or 0 price. Then I go back up top. You'll note that it then records this loss of 15,627 on page 1 of the 1120, and then we're out of balance down here. So what we're going to do then is now put the proper sales price in, which was, we said, let's see, what did we say? We looked it up in the general ledger, and it came out to 29,524. So we're going to go back over and say, all right, that number should be the sales amount of 29,524. 29,524, right? Let me check that one more time. 29,524, right? Then I'm going to go back up, and now we're at the 13,897, which you'll recall was the gain on a tax basis, because this page 1 is being recorded basically on a tax basis. Now let's see page 6 and see if it generates an M1 and see if we're in balance. We're out of balance. We don't see the M1. Why? Because we negated it last time. You'll recall we wanted to focus in on this depreciation, and we negated the M1 that was related to the sale of the equipment. So now I'm just going to remove that negation and see if that puts us back in balance. We're going to say jump to the input here. We had this negation here. I'm going to say, all right, I'm going to remove that now. I'm going to delete that and go OK. Go back to the forms. And so there's the M1 adjustment. Back up top, does that put us in balance? We're still out of balance. Let's check it out. I'm going to go, all right, we're out of balance here. We have the 6283,500 minus the 6286, and that's going to be the 2,500. And I go, all right, that looks like, if I go back to my forms over here, that looks like it is what we recorded in the gain. And you'll recall we kind of forced that. That's an override that we did to be in balance. So I'm going to say, all right, that's the override we did. If I go back to page 1 and say we put that into other income. We put that into other income here. So I'm going to jump to that. I'm going to say, I'm going to go to the other income. And I'm going to go into here. And there's the 2005. I'm going to record this with an M1 so I can kind of see the journal entry that we're creating. I'm going to say negative 2,500 to negate it. And this way I can go back in and kind of see what I'm doing as I go rather than delete it. And if something's wrong, then I don't have to, don't have to re-put in this number. I can just delete this one. So I'm going to say, okay, go back to the forms and see what happens here. And then go to the page 6. Does that put us in balance? That does put us back in balance. So everything worked out there. Let's go ahead and see if we can figure out what happened from a journal entry standpoint with our Excel worksheet. So what happened here? We're going to say that the same process, instead of trying to figure out the difference, instead of trying to go straight into the M1 down here and figure out the difference of this 11,397, I'm going to reverse the sale on a book basis and then record it on a tax basis because it's easier to record the full sale process, in my opinion. The difference then, as we record it, will be the 11,397, hopefully, if everything goes smoothly. So I'm going to go back to and say, I'm going to say this is a tax journal entry. This is going to be reverse. I'm going to make a note. We're going to say this is to reverse sale on a book basis, so we can record on a tax basis. All right, and so I'm going to say a normal sale, I'm going to construct it as a normal sale is constructed. I'm not going to try to put the debits on top. I'm just going to think through it, how a normal sale happens, and then reverse it. So I'm going to say, all right, we have usually, if something was sold, we're going to get cash, and then we're going to say the asset's going to go off the book, the depreciable asset, the equipment went off the books, then the accumulated depreciation related to it went off the books. This is how I would construct it. And then I'm going to say that there was a gain or loss. The gain or loss is going to be that $2,500. So the cash is going to now be credited because I'm reversing it. So I'm going to reverse it for tax purposes. The whole thing, I'm going to go down. That was when we looked at the GL and the detail, the $29,524. And then the depreciable asset, if we go back to our depreciation schedule, was the $50,000 piece. I'm going to go to the book depreciation. So the cost was 50. So we're going to put it back on the books. And then we're going to say the accumulated depreciation related to it was the current portion of the 2,976 plus the 20,000 or 22,976. So I'm going to say, all right, now I'm going to say this is going to be negative 22,976. Going to put it back on the books or credit it. And the difference should be the gain. So I'm going to reverse the gain with a debit. And there's the reversal. So this and then we'll post this. I'm reversing the book transaction. So cash is going to go down. I'm going to go up to the cash. In Q5 equals, we'll say the negative 29 or credit, bringing it down. I'm going to go to the depreciable asset. In Q11 equals, we'll pick up the 50,000. Then the accumulated depreciation. So that's going to be in Q12, something's in it. I'll double click on it, go to the end of it, and plus, we'll pick up that 22,976 and enter. Then we're going to go down to the gain from the disposal in Q25 equals, and point to that 2,500, bringing it down to 0. And then if we scroll down, we're back in balance given by the green zeros. So we have reversed that successfully. Now we're going to record the same transaction basically on a tax basis. So I'm going to say, all right, now I'm going to do another journal entry on a tax basis. I'm going to say we have record sale of equipment on tax basis. Same journal entry, but this time I'm just going to change the debits and credits. I like to just have the order of the accounts the same because this is how I would normally see a sale transaction happening. We're going to say that we then got cash. The cash is going to be now going back up. I'm just debiting and crediting the cash, it's going in and out. And then we got the depreciable asset, same. It's going to be on the book. It's at 50,000. We put it on and back off again. So you might say, hey, this is excessive. Why do I need to do all this? Because it's easier to see than trying to subtract them out, in my opinion, to actually build the whole transaction. And then we're going to say the accumulated depreciation, which is the differentiating factor here. So we go back to this item and we go to the book. That's now going to be current portion 4,373 plus the 30,000 now for the 34,373. So this is on a tax basis, not the book basis, tax basis. All right, so we're going to say this is going to be 34373. It's going to go down, and then we're going to say negative sum plug formula for our gain now on a tax basis being that 13,897. You'll recall if we go back to our tax forms to the 1120 page 1, that's that 13,897. So that looks familiar. That looks correct. Let's go ahead and post this out and see what happens. We're going to go back up top to the cash. Something is in it. I'm going to double click on it, go to the end of it and say plus, scroll back down and record the cash and enter. Then we're going to record the depreciation. Here's the ending cash. So it goes back down to 0. Then we're going to record the depreciable asset. Back up top, here's the depreciable asset. Something's in it. Going to double click on it, go to the end of it, plus, scroll back down, and we're going to pick up that 50,000. Once again, it just goes up and down back to 0. Then the accumulated depreciation, the key factor, is going to be the next one. Recording this item. Going back up, accumulated depreciation, double clicking on it, go to the end of it, and plus, put the cursor back down. We're going to pick up that 34,373. And so there's the difference. There's what we're looking for there, part of the, and then we're going to go to, obviously this number now is taken into consideration all these items, because it takes into consideration depreciation from the M-1 last time. If you want to know where these little resources are, by the way, very useful to see what's included in this cell. You can also double click on it and see what's in there. But if you have a lot of stuff going on, you can use these. I typically go to the formulas. It's in the formulas, and then you go to the formula auditing, and these are your items. I usually right click on them and put them into the ribbon, customize the ribbon. So I'll remove that, and then we're on the gain from sale. So that's going to be down here. Again, something's in it. Notice if you can double click on this, or you can also hit F2 on the keyboard, plus, and then if you want to move around, not use the mouse, you can go F2, and then you can move with the keyboard, removing the mouse, which is more geeky, which is good, faster or whatever. And so there it is, the 13,897, scrolling back down, and we're back in balance with the green zeros. So let's check our numbers then. We're going to say, so if we go back to the tax return, then we're going to say, all right, page 1, we're now at that 13,897 for tax purposes for the gain. And that should tie out here to our 13,897. And then we're going to go to the page 6. We're going to see if we're in balance. So we are in balance. We're going to check our income numbers. So the first income or book income, 1461500. So scrolling down, we've got the 1461500. Then on the tax side of things, we have the 1418629. So that's going to be the 1418629. The difference then is now this 11397. So if we scroll back up, we see the 11397, which is the difference in the gain here. So I'm going to ungreen this. Now, we should also be able to take a look at these two amounts and remove kind of our override for those two amounts. So I'm going to remove the override. I'm going to go back up to our forms and say, if I remove these two, they should basically remain the same at this point in time. Now, remember, these are on a book basis, the 1650. So this is the 1650 and the 505101. Those are on a book basis because the Schedule L is basically on a book basis, and the difference, the change between the book and the tax, is the M1 adjustment down here. All right, so we're going to go back and we're going to say, let's go to this data input, and I'm going to go to the balance sheet and say, now I don't have to force these two items because we've now removed all the overrides, and we told the system to use a book and tax depreciation. So I'm going to delete these two and see if we still remain in balance. They should remain the same number, in other words. I'm going to go back to the forms. So we have the 1650, that looks good, and the 505, and we're still in balance here. That looks good, and we still are looking good here. So there we have that. That's going to be kind of the most, again, that depreciation, sale of equipment, kind of the most difficult types of transactions. Also note that you could check out the 4797 sale of business property. So the sale of business property, 4797, where we have the 13,897. That's going to be the tax gain, you'll recall. Page 2 then will give you the detail, and note we didn't have the 179 information here, so there was no prior 179 or special depreciation. So we're on the form 4797 where we had the gross sale of the 29,524. You'll recall, of course, that that's going to be our sales price down here, the 29,524, and then we'll scroll back over. Then we had the cost being the $50,000, the depreciation that we saw on the depreciation schedule, the $34,373, that giving us the basis of the $15,627, and then the gain of the $13,897. Notice this format ties out nicely if we think about it in kind of like a journal entry format. The 29,524, the 50,000, then the 34,373 ties out here, and we have that working nicely, which wouldn't work so nicely. We couldn't tie this schedule out so nicely if we tried to just record the difference, the M-1, rather than reversing the book transaction and then recording the tax transaction. This can act like, in other words, basically a recalculation of the gain here rather than kind of putting it in a separate type of schedule. Now we can also go to our open items and we can start crossing things off here. So I wouldn't delete the open items here. I'd cross them off, and that way you can show your work as you go. So I'd go, okay, here's the open item. I'll cross it off, draw a line through it. Accumulated depreciation has been overridden. So I'm going to go ahead and cross that one out. So we cross that out. I'm in the Home tab fonts, and I'm just crossing it out if you're using Word for this process. But then we had the capital gain. We had the gain on sale of fixed assets. We've done that. So I'm going to cross that one out. So those are going to be some big items. Depreciation, book adjustment. So we did the depreciation. So I'm going to go ahead and cross that off. And then meals, M1 for depreciation. Then we did this. We used the schedule number 4 on the schedule. I'm going to say that's good. And then we have record proper gain on sale. We've done that. Notice some of these are probably repetitious when we jotted them down because we did multiple things that are kind of related in some way. So that looks good. We've got a lot of stuff that we kind of crossed off there. I'm going to save that. I'm going to go back to the tax return. That looks good. And then I'm going to go to the Excel and go ahead and save that.